What is going on, investors? Welcome to my channel. This is Jason, aka the Frugal Investor. This video is going to be one of my favorite videos because this video is about one of my biggest holdings and my favorite holdings, which is Facebook. The stock is down by almost 32% just in my portfolio. I own almost 6 to 7% of my portfolio is in Facebook, and my return on this company so far is down by almost 32%. My entry price is $295. So we will talk about some of the reasons why this stock is down. Basically, there are three main reasons. Number one is the earnings miss. That was the most recent earnings. They missed on their earnings per share. It was expected to be 3.87. It came out around $3.67 per share. Also, the privacy laws in Europe and in Apple privacy laws, they are hurting the company a little bit. Also slowing growth of Facebook users across the world, a slowing growth of platform use with competitors like TikTok and YouTube coming in the market. It has really pushed the time limit that people spend on Facebook. It has really pushed it down. Also, not a lot of people are not signing up. So those are three main reasons: the earnings miss, the Apple privacy laws, and the Europe privacy laws, and of course the slowing down growth of Facebook platform as compared to TikTok and YouTube. So those are the three things we are going to discuss, and we are also going to discuss the discounted cash flow model. Based on the discounted cash flow model, including the slowed down growth, including the slowed down growth in Europe, and if they stop doing business in Europe, as the news came out that Meta might be moving out of Europe if they enact their privacy laws that are being discussed right now. So those things we are going to discuss. We are going to make sure that we capture that in the discounted cash flow model, and we come up with the price based on that. So Meta is facing a lot of headwinds because of their privacy situation. They share data back to United States from Europe, and that is causing a problem over there. Apple is strictening its privacy features, which can cause a huge dent on how Facebook makes money from advertisement and how Facebook shares data with people, and based on that data they show advertisements. So a lot of headwinds for Facebook and a lot of headwinds for Meta. How they are going to navigate those headwinds is going to be interesting to see. So the market is pricing that in the stock price. The stock price is currently at $224.91. So it's dropped from its all-time highs of like $360 to $370, and it's down to $224. So a huge drop in the stock price. The market is pricing in the fluctuation. The market is pricing in the negative sentiment that's around this stock, and we are going to discuss some of that in this video and kind of give you my perspective, my long-term perspective, because I hold such a big portion of it in my portfolio. Almost 5 to 6% of my portfolio is in Meta. So kind of give you my perspective of what I am thinking, and what I think. Am I buying more? Am I selling Meta? Am I getting out of it? What is my perspective on this? That is what we are going to discuss in this video. First thing, let's talk about the missed earnings report. The earnings per share were expected to be $3.84, and it came out to be $3.67. So there is that, which caused a huge stir. The stock just crashed down, along with the news from Apple privacy laws that they discussed in their earnings call as well, along with the news coming out of Europe that they discussed in their earning call as well. So both of these things, they crashed the stock down. They hit Meta pretty hard, and it's actually quite interesting to see, how they will navigate these things, how the privacy laws that are being enacted, how the privacy laws that were enacted in Ireland recently, and how they are navigating through this. That will be interesting to see, because their whole business model is based on selling advertisement. And I know they are working on Reality Labs, which is their new business segment, which consists of the virtual reality headsets and metaverse and whatnot. But it will be interesting to see how they navigate these things. Can they really navigate these things? Because 30% of the phone market in the United States belongs to Apple, and if Apple enacts certain laws which makes it harder for Facebook to do business in the United States, that's like 30% of Facebook's business right here in the United States that can be in trouble, that can be reduced to shambles if they don't do something about it. So those are some of the things that we are going to discuss right now. So the revenue reduced because of these reasons, the privacy laws that are being enacted by Apple, and all the things that are going on. Revenue was came down from three. The revenue, it's actually gone up from 33 billion to 33.4 billion to 33.67 billion. So revenue is up by 20% from the last quarter. Daily active users grew by 90%, and family daily active users grew by 8%. So there is that growth also, but their growth is not that crazy. The company still has zero debt. Okay, this is wonderful. The company has no debt and $16 billion cash on hand as per this quarter. They still have a lot of cash on hand and they have no debt. So it's in a fantastic position cash wise and debt wise. Okay, the capex increased to $19 billion in 2021, expected to be $34 billion in 2022. So capex is the capital expenditure that they are doing. That is also something as an investor, that I'm keeping an eye on, because uh, where are they spending this money? Most of this money is being spent into metaverse and this virtual reality headset, the reality labs platforms. They're spending a lot of money on that because they want to make it their one of their biggest revenue streams. So that is also interesting to see that they're spending so much money in capex. So that is also one thing that is interesting to see, and they are increasing it to be 34 billion in 2022, which is a huge number. So that is also interesting. That's what's going on. The operating income and gross profit. So gross profit has gone down. The operating income has slightly gone down because they are taking losses in their new segment, which is Reality Labs. They are not profitable there yet. They lost $10 billion, and a revenue of $2.2 billion came from that. So they are losing almost $8 billion in that segment, $7 to $8 billion in that segment. So that is a huge loss they are taking right now. But it's a new segment, so it will take at least 7 to 8 years for that segment to start generating revenue, start generating some kind of profit. So that to that, my saying is, like, if people are interested in speculative plays, like, something like Square, which has a P by E of over 60 and things like that, in some way, shape, or form, it's similar to that. It's not exactly similar to that, but some way, shape, or form, they can put such a high P by E on that company. Why not put a high P by E on this company? And Square is a good company. I'm not saying Square is a bad company, but just for reference. So they are also doing something innovative. Metaverse is the future. Web 3.0 is the future. AI platform is that they're building is the future. The headsets, the virtual headsets, that is the future. So that is what my point is. If this thing starts generating revenue 5 to 6 years down the line, it can be a huge hit for them. And that is why I have huge hopes for Facebook in the long term, based on this model as well. And I'm pretty sure they are doing something in the back end with the privacy laws and things like that. But it's interesting to see how they navigate it. Okay. Their social media platforms have been getting more and more profitable. So their legacy platforms, which is Facebook, WhatsApp, Instagram, they have been getting more and more profitable. Their profit margins have been increasing. But their new business, which is Reality Labs, has been losing money. So which is, as I said, which is a new business, it will take some time for it to be profitable. But their legacy platforms, they have been getting more and more profitable. So they are in becoming more and more efficient into managing these platforms and generating revenue from them, which is a really good news. That is what you want to see. Okay, so ad impressions delivered across our family of apps increased by 10% year over year in 2021, and the average price per ad increased by 24%. So there you can see the pricing power that this company has. They increased the price per ad by 24% year over year. So that is also fantastic to see that they have this pricing power with their legacy platforms that can help them generate more money, more revenue from their platforms, and which also, so improving efficiency, generating more revenue from the existing customers. That is also a great thing. That is also helping them grow really, really fast. That is also what came up in the earnings call this week. So moving on to the next part that came up is the free cash flow has gone up from 23 million in 2020 to 38 billion in 2021. So this is billion. Sorry, excuse me for the grammatical errors that I'm doing and the numerical errors that I've done in this one. So the free cash flow went up from 23 billion in 2020 to 38 billion in 2021. That right there is a almost 37% increase in the free cash flow, guys. So it's not like the company is dead in the water. Okay, they are innovating. They are coming up with Facebook Reels. They are coming up with Facebook Shorts. They are coming up with WhatsApp status and all these different kind of things they are coming up with to kind of innovate and to kind of navigate this new landscape with TikTok and with YouTube and YouTube Shorts and so on and so forth. So they are also innovating. They are also fighting. They are also coming back up with new things. They are also generating new products that are more innovative, that are more suitable to the needs of today. So that is one very good thing. The cash flow increased from 23 billion to 38 billion. Okay, that is a very good thing. So the capital, so these capital expenditures, so the capital expenditures, that is they are going to be spending 34 billion next year on capital expenditures, which is innovation and research and development around new things. So they are building up servers, network infrastructure, office facilities, data centers, uh, increase in AI and machine learning platforms, as you can see right here. This is directly from their 10K. So they are increasing their in AI and machine learning platform investment, which is also a good news because this will play a big part in the long term. So in the long term, if I see that what they are doing, it makes sense because they are thinking long term and they're going the long way and they're investing in the future, which is also a great thing that I see for Facebook. Okay, 19.2 billion worth of shares were repurchased by management this year, and 38.9 billion is authorized for repurchase as of 31st December. So that is where you can see that they are themselves are bullish on their stock, and if they repurchase the share, the amount of shares outstanding in the market will go down, which will create a more demand for the stocks as well, which can push the price up as well. So they are repurchasing their share, and right now the share is available at a very cheap price. So I think it will be a very smart move for them to repurchase almost $38.9 billion worth of their own shares. So that is also a very good news, and that is also what we learned through this earnings call. So some bad and some good. The privacy laws with Apple and Europe were bad, and Peter Thiel is stepping down. These were some of the bad kind of angles, and the good kind of angles were, the share repurchases and how they're investing in the AI and machine learning platforms, how they're investing in the future, how they're investing in the reality labs, how the profit margins are increasing, how the efficiency of the legacy platforms is increasing. So those were some of the good news that we heard. So 45% of the world is using Facebook as of now. So a huge amount of penetration into the world markets. 45% of the population is using one of their platforms, whether it is Facebook, Instagram, WhatsApp, on a monthly basis. So that is a huge number. That is a huge network effect that is created. So it is not that easy to kind of break that network effect within 1 month or 1 year or 2 years. This will stay. This has a lot of staying power when it is penetrated among these many masses. It gets a lot of staying power from that network effect. Again, as we talked about the privacy conflict situation with Apple, that was also brought up in the conference call. 30% of the market in Europe and 50% market in US is controlled by Apple iPhones. So it will be a huge hit to Facebook. Also, the privacy situation arising in Europe is also going to be a big hit to Facebook if that comes through. So it will be interesting to see how they navigate through these privacy issues that they are having, because their ad business is solely based on the data they share with each other and the data they capture from the people that are using their platforms. Based on that, they show you the ads. Based on that, they make money. Based on that, that is their biggest revenue generator. So it will be interesting to see how they navigate through these waters, because that is what will determine how the future growth, the future revenue, the future profitability of this business will look like. The earning lows can be linked to how Apple is dealing with this privacy issue. The privacy issue is the main reason they are hitting this hurdle with their earnings and all not whatnot. So a lot of younger people are moving off of the Facebook platform, and they're moving into Instagram, they're moving into TikTok and YouTube. But Instagram has still held a stranglehold on the crowds, along with WhatsApp. They have a stranglehold on the crowds and the young people. So it will be very hard for TikTok and YouTube to kind of defeat Facebook in that sense, that because they have Instagram, they have WhatsApp, which serve as a very kind of like very stronghold platforms among the young people as well. So growth is coming from those platforms. Facebook is losing popularity among younger people, and older people are the people that are generally using Facebook as per their earnings call, and the younger people are moving more towards these TikToks, these Snapchats, these Instagrams and things like that. And Facebook is very rightly positioned there with Instagram and WhatsApp. So that is also a good thing, a bad and a good thing. So if you are investing in Facebook, if you are investing in Meta, practically you are investing in a person's social identity. So that is where these privacy laws play a big part, because when you are buying Meta, the people that are using it, they have a social identity with the things they use, the things they see, the things they do, things they like. That gets collected. And with this virtual world that is coming in, the metaverse, and it becomes part of one's identity in general. That is what you are investing in with this metaverse and this virtual reality world that is coming in, and that is going to be playing a big part in the future, as they say. So it's going to play a big part in that. And when you are investing in this company, you are investing in that reality of social personality of someone. Now, those were some of the basic facts that were discussed in the earnings call. Now, let's move on to the discounted cash flow model. This is a very rough draft of the discounted cash flow model. I hate using Excel, and so that's why I created this rough draft. I will explain to you point by point what I'm doing and what is kind of it looks like a jumbled mess right now, but bear with me. I will explain to you everything that I'm doing right here, and it'll all make sense to you just in a moment, right? Okay, so cash flow grew by 37% year over year, from $10.09 per share to $13.77 per share in 2021. Okay, that is their current cash flow. So it's a growth of 37% year over year. So if I divide the cash flow per share with the stock price that is currently there, we get a P by E of 16, right? So P by E of 16, how did I get a P by E of 16? I divided the current price of the stock with the cash flow per share, which is of this year. So currently the stock is trading at a P by E of 16 based on the cash flow. Okay, based on the cash flow that they're giving to the people, because cash flow is after everything has been taken out, after all the expenses, the this and that, the interest payment, whatever you want to count, everything's been taken out. What is coming to in your hands as a business owner? $13.77 is coming to you in your hands, the business owner, and that gives you a P by E of 16. Okay, some people do it with earnings per share, but I prefer cash flow because cash flow is even more even more kind of centered and saturated than the earnings per share. So let's assume the cash flow grows by 15%. Currently, it's growing by 37%. Some year it has grown by 65%. Some year it has grown by 57%. But we are taking everything, like the Apple privacy situation, the everything that's going on. We are taking a very discounted number, which is 15%. Let's assume the cash flow will grow by 15% every year compared to 37% and 42% from the previous years. That is what it grew by in the previous years. We are taking 15%. So we are counting in all the risks. We are counting in the slowing numbers of growth. We are counting in a slowing growth over time. We are counting in the falling profits. We are counting in a lot of different factors. We are counting in the privacy laws in Europe. We are counting in all the different factors, right? We are taking in the worst case scenario, and we are assuming 15%. Forget about the 37, forget about the 42, forget about the 65. Focus on this one. It's a very discounted number. Okay, based on that, we will count the cash flow in the upcoming years. So 13.77 is this year. Next year, we take a 15% growth in that, plus the number comes out to be $15.77. A 15% growth in 2025. In 2024, actually, 2023, actually, 2023, that free cash flow will be $15.77. And the intrinsic value of the stock, based on a P by E of 16 that we just counted up there, which is a current P by E, we will get a $252 stock price. That will be the intrinsic value in 2023 based on the P by E of 16. Okay, if you want to reduce this to like 10, you can make that as well. That will bring you 157. So you can do whatever, you can play around with these numbers. This is very simple model. I haven't used Excel. Sorry if it looks a little jumbled, but this is what the intrinsic value will be based on the current P by E. And the current P by E is really cheap. The stock has taken a huge hit. The stock is at an all-time lows. So the current P by E is really low. So 16 P by E based on the cash flow will give you an intrinsic value of $252 in 2023. In 2024, same amount of growth, 15%. We are getting an intrinsic value of $290 for the stock. In 2025, we are getting an intrinsic value of $333 per stock. In 2026, $384. In 2027, $442. By 2030, this number will be over $500 for one stock. So this is just a very simple model based on very decent growth number, which is 15%, which is nothing compared to the 37%, the 42% we have been seeing recently. Okay, which is very generous compared to that. And we are doing a modest P by E, which is 16, which is at an all-time lows. With that number in 2027, you have $442 stock price, which is double of what it is right now. So based on these numbers, based on these calculations, we can see that the stock is very underpriced $224.91. The stock is available at a huge discount, and it has gone down by almost from $323 at one point, $332 at one point, has gone down to $224. So down by almost 30%. Just so, is this overreaction by the market? I think the market is overreacting, and it is giving a great opportunity for people like us, people long-term investors like us, to kind of jump in and take use of this opportunity and buy this fabulous, fantastic company at this price. But you also have to keep the risks in mind, which are already priced in into the stock, and which are already priced in into my discounted cash flow model as well. That the privacy laws, if they change, they can have a huge impact on the way Facebook does business. So that is also a very great risk factor that you have to see. But in my opinion, I think the market is overreacting. I think this price is fantastic price for a business like Facebook. The fabulously managed, huge, fabulous business model. I think the market is overreacting. And the message I want to try to get across in this video is, guys, don't get trapped up in the short term fluctuations. Yes, keep an eye on the news, keep an eye on the things that are going on with your businesses, but don't get trapped up in kind of that short-term fluctuation and that sheep mindset of what everybody else is doing and running around. I have heard a lot of people, they're trying to sell Facebook. They're asking me, hey, should I sell Facebook? Should I get out and should I buy something else? What should I do? Should I do this and that? Do not get trapped in that mindset. Think long term. The fundamental is looking good. Okay, the fundamentals look good. They're innovating. They're spending so much money on research, and their capex is increasing to 34 billion. That means they are hurrying up their platforms like this virtual reality and metaverse. They're hurrying that up. They're investing so much, which will it'll be a big revenue generator for them. So think long term. Kind of keep that long term picture in mind, even though you keep your eyes on the ground, but keep that long term picture in mind as well. That is what the message that I'm trying to get across through this video. With that said, guys, this was my analysis of Facebook. This was my thoughts on what things are looking like right now, what my long-term kind of mindset is about Facebook. Please don't forget to like and subscribe, and thank you. Shout out to everyone who likes, subscribes, comments, and emails. Much love to everyone. We are building a beautiful community here. We are building a beautiful community of like-minded investors, long-term thinkers, business owners. We are building a community of future millionaires, billionaire investors, long-term people, long-term thinking, and long-term business owners. Thank you for watching. This is the Frugal Investor signing out.